Welcome to Earnings Intelligence. Today, we're cracking open a time capsule, Berkshire Hathaway's 1997 annual report. Now, this isn't just about looking back at a single year. This is basically a masterclass from Warren Buffett on finance and long-term thinking, right in the thick of a massive bull market. We're going to deconstruct the numbers, unpack the core philosophies, and see why the lessons from 97 are, believe it or not, just as powerful today.
Okay, let's just jump right in with the headline number. In 1997, Berkshire Hathaway grew its per-share book value by a jaw-dropping 34.1%. I mean, think about that in one single year. For a company of this size, that's just a phenomenal result, the kind of thing that gets splashed all over the news. But as you know with Buffett, the headline is never the whole story.
And just as you're absorbing that incredible number, he brings everybody right back down to earth with this. This is his famous preening duck analogy. What he's basically saying is, hey, when there's a torrential rainstorm lifting all the boats, or in this case, all the ducks, you can't get cocky and think your amazing paddling is the only reason you're floating so high. It's a classic lesson in humility and a huge warning against confusing a rising market with your own personal genius.
So, here's our game plan for breaking down this report. We're going to start with that quack and figure out what it really means. Then we'll get into the weeds, decoding the financial statements, the real engine room of the company. We'll look at Berkshire's two main drivers of value, explore the incredible investment discipline that guides them, and soak up some timeless wisdom on markets and mergers. And finally, we'll tie it all together with the enduring legacy of this amazing year.
So let's start with that quack. While that 34.1% gain in book value is the official metric, Buffett immediately warns us to look deeper. He wants our focus on what he considers the true measure of success, intrinsic value.
So book value, which was over $25,000 a share back then, that's the accounting number. It's what the company is worth on paper, assets minus liabilities. But intrinsic value, that's Buffett's real scorecard. Think of it as all the cash a business is going to generate for its owners over its entire lifetime. Now, it's an estimate, right? Not a hard number, but Buffett is crystal clear. Berkshire's intrinsic value is far, far higher than its book value.
All right, let's roll up our sleeves and get into the mechanics of the business by decoding the 1997 numbers. This is where we move past the philosophy and into the hard data, where you can really see the power of this company in black and white.
First up, revenue, what a lot of people call the top line. It's simple, really. If you own a coffee shop, your revenue is the total amount of cash in the register at the end of the day from selling all the coffee and pastries. Before you pay for the beans, the rent, or your employees, it's the starting point for everything else.
And here's Berkshire's top line in 97, over $10.4 billion. What's so important here is the mix. You've got almost $4.8 billion from insurance premiums, sure, but then you have almost $3.6 billion from actual sales at businesses Berkshire owns, like See's Candies. This diversity shows it's a real operating giant, not just some investment firm. And get this, it was crazy efficient. The operating margin was over 20%, which means for every dollar they brought in, more than 20 cents dropped down to operating profit. That is a sign of incredibly healthy businesses.
Okay, so if revenue is the top line, then net income is the famous bottom line. Back to our coffee shop. After you've paid for everything, the beans, the electricity, the taxes, all of it, whatever's left in your pocket, that's your net income. It's the actual profit.
Berkshire's bottom line in 1997 was just over $1.9 billion. Now, this number gives us another key metric, earnings per share, or EPS. For every single share of Berkshire stock out there, the company earned about $1,558 in profit that year. Investors follow this number like a hawk because it shows you exactly how profitable the company is on a per-share basis, which is what you, as an owner, actually care about.
Next up is operating cash flow, and this might be the most important metric of all. See, it's different from profit because it's the actual real cash that the business generates. Profit can include all sorts of non-cash accounting stuff. Cash flow is like the oxygen a company breathes. It's what lets you pay your bills, reinvest in the business, and grow.
And here is the crucial point. Berkshire's operating cash flow was over $2.3 billion. Notice how that's significantly higher than their net income? When a company generates more cash than profit, that's an incredibly powerful sign of financial health. This absolute gusher of cash creates a fortress-like balance sheet with a very low debt-to-equity ratio, meaning they have very little debt compared to their net worth. This is the raw fuel that Buffett gets to put to work.
Which brings us perfectly to our next section, understanding the two powerful engines that drive the whole Berkshire Hathaway machine.
It's how these two things work together that creates the real magic. This table is straight out of the letter, and honestly, it tells you almost everything you need to know about Berkshire. Just look at those two columns. On the left, you've got the per-share value of their stock investments. On the right, you've got the per-share earnings from the actual businesses they own. The key isn't just that both of them have grown to these astronomical numbers, it's that they fuel each other in this incredible virtuous cycle.
So, how exactly do they fund that massive investment engine? Well, that leads to a really fascinating question. How is it even possible to get paid to hold and invest billions and billions of dollars of other people's money? The answer is something called insurance float, and it is pure genius. An insurance company collects all the premiums from its customers up front, but it might not have to pay out claims for years, if ever. That giant pool of money it's holding in the meantime, that's the float, and Berkshire gets to invest that float for its own profit. It's essentially a giant loan from its customers. But here's where it gets truly insane. This table shows Berkshire's cost for that float. Because their insurance businesses were so well run and profitable, their cost for this multi-billion-dollar loan was actually less than zero. This is the supercharger on Berkshire's investment engine. They aren't just getting free money to invest, they are literally being paid to hold over $7 billion, which they then get to deploy into their portfolio. It's a financial advantage that almost no other company on Earth has.
So you've got this fire hose of capital coming in at a negative cost. What do you do with it? Well, that brings us to the philosophy that governs everything, the art of not swinging.
Buffett loves this analogy from the baseball legend Ted Williams. Williams figured out that if he only swung at pitches in his absolute perfect sweet spot, he'd be one of the greatest hitters of all time. For Buffett, investing is a no-called-strike game. That means he can stand at the plate all day and just wait for the perfect pitch, a wonderful business at an attractive price, and he has the discipline to let everything else just fly by, no matter how tempting it might seem.
Okay, let's zoom out a bit now and look at how Buffett's philosophy applies to the wider world of market swings and corporate takeovers. His perspective is, very often, the complete opposite of what you hear on Wall Street.
This is the hamburger analogy, and it's so simple, it's brilliant. If you know you're going to be eating hamburgers for the rest of your life, do you want the price of ground beef to go up or down? Down, obviously. Buffett argues that if you're a net saver, meaning you'll be buying stocks for years to come, you should be thrilled when prices fall. It just means you can buy more of your favorite companies for the same amount of money.
And here, you just don't see this kind of honesty from CEOs very often. Buffett calls this his confession. He flat out admits that when he has used Berkshire's own stock to buy another company, it has almost always been a mistake for his shareholders. Why? Because he's trading away a small piece of his existing, proven, incredible businesses for something new and less certain.
And that's the key takeaway. For acquisitions, cash is king. Using cash doesn't dilute your ownership stake in Coca-Cola or Geico. He calls his collection of businesses a roster of .380 hitters. It's almost impossible to trade one of those away and get something better in return. Using cash protects the incredible value and quality that shareholders already own.
So let's bring it all home and look at the enduring legacy of this report and the principles that are laid out so clearly within it.
And to really drive that point home about having a roster of .380 hitters, just look at this. This is a snapshot of Berkshire's biggest public investments at the end of '97. We're talking about some of the most dominant, powerful brands and businesses on the planet. When you own pieces of companies this good, you become incredibly hesitant to trade away even a tiny sliver of them.
And that really brings us to our final thought. The 1997 report is a masterclass in principles that feel almost radical today: patience, rationality, and this relentless focus on long-term intrinsic value. The question it leaves us with is a really powerful one. In a world that seems to move faster every single day, can this same discipline still be the blueprint for building the enduring business giants of the future? Thanks for joining us on Earnings Intelligence.